What if I told you the market could drop by 50% and I still wouldn't sell? And it's not because I have small feet. Well, they are kind of small. But anyhow, in this video, I'm going to go over why, despite the sell-off, we'll be okay as long-term investors. And towards the end of the video, I'll tell you when I do sell my stocks. So let's go ahead and talk about the goods and the bads of a market crash, recession, depression, all of that bad stuff. When the market is tanking like this, I get it. It's not all joy and celebrations. There are some of us that have our entire net worth tied up into stocks, and seeing your portfolio go into the red by 30% or even 50% is not a good feeling. And to take it a step further, the ramifications of a stock market sell-off, when you think about it, the human element to the stock market crash is that people are going to be laid off. People will have to delay their retirement, and some people will even lose their homes. That's the harsh reality for some people. However, even during dark times, if you're in a blessed or fortunate position, this is a really good buying opportunity. During a market sell-off or a bear market, you have the opportunity to buy into companies with a discount rate of like 30% or even 50%. The companies that you have been eyeballing or have been on your watch list for many years, now they're going to be in the undervalued territory. What's not to like? But why am I not freaking out? Well, history shows that bear markets are normal, and they typically only last about 9 months on average. Sometimes it lasts a lot longer, and other times it is super quick, short-lived. All that to say, the stock market does not just go up and up. The stock market goes through natural cycles of highs and lows depending on the status of the economy, the consumer, inflation, and other macro environment factors like the pandemic or tariff war, such as right now. Let's look at the facts. There have been 31 recessions that have happened in the US since the Civil War, which is the 1860s. 16 of those recessions ended the year on a positive note, whereas the other 15, well, they ended the year deep into the red. And the recessions that did have those negative returns, on average, they lasted 17 months. So it's about a year and a half and some change. The worst one out of the bunch was the Great Depression that lasted from about August of 1929 to March of 1933. That's pretty long, I'm not gonna lie. That's 43 months total. Now on a high level, let's go ahead and look at some recent examples. First up is going to be the 2008 financial crisis, otherwise known as the Great Recession. And during that period of its high to its low, it was a decline of 57%, which it reached in March of 2009. So if we look at a timeline in October of 2007, the S&P 500, which we refer to as the market, as depicted by SPY, was trading for around $155 a share. And then as you can see in the subsequent months, the market went on a massive sell-off and was into the red by almost half. Can you imagine if your portfolio was valued at about $1 million in about a span of, 5 months or so? It would have been valued at about $500,000. However, look at what happened eventually. With time, the market did its thing and it recovered. For you to break even into SPY, it would have taken you about 6 years. I know it sounds like a long time, but eventually you would have recovered, and then look at what happened the following year. You would have been into the green, and then you fast forward another 5 years or so, and then look what happened, right? In the grand scheme of things, the market will be okay. Let's go ahead and look at one more example in recent times, known as the 2020 pandemic COVID crash. From its high to its low, from the peak to the valley, you would have seen a decline of 34% in a matter of weeks. However, let's look at what happened and how that played out. So in the context of SPY, back in February of 2020, it was about $333 a share. And then look at what happened in the following weeks. It went on a massive sell-off, and at its low, it was at about $226 a share. However, did it take 6 years for it to recover? No. In a matter of months, at about August of 2020, you would have been at a break-even price point. And then since then, of August of 2020, look at how the market has performed. Sometimes it goes up, like you see right there, and then sometimes it goes down, and then it goes up. So during the COVID pandemic sell-off, from its high to its low, we saw a 34% decrease in a matter of weeks. However, what is absolutely crazy is that 2020 ended the year on a positive note, and the S&P 500's return was 18%, as depicted by the this graph right here. You would think that during a pandemic sell-off, it would have been into the red and they would have stayed in the red, but it only took a handful of months to be positive. On the flip side of that, when we take a look at the Great Recession, yeah, they ended the year into the red by negative 37%. Even though its peak to its valley was 57% in the red, they eventually recovered by 20% by the time the year ended in 2008. And in the following year of 2009, you were in the upside by 26%, and in 2010, you were in the upside or in the green by another 15%. Time in the market does its thing. But going back to the 2020 sell-off or correction, what I'm saying is there can be a V-shaped recovery within the same calendar year. And if not, it'll take a few years for it to recover. It's not going to be the end of the world. Unless, of course, you bought into the S&P 500 at its absolute highest price point, at its very high peak. Then, of course, it would have taken you about 6 years to recover. But for most of us, I don't think we're doing a lump sum investment when the stock market is at its absolute highest price point. So, case in point, roughly a few years for you to recover and break even. Okay, but that still doesn't answer the question as why am I not selling? You're absolutely right. So the main reason is that panic selling absolutely demolishes and destroys any kind of wealth building. There was a study done a handful of years ago, and they found out that the best retail investors are the ones that have passed away. Reason being is that instead of panic selling during the tough times when they see their portfolio drop by 20% or 30%, instead of doing that, they held on, and their portfolios compounded through the ages. Of course, in their example, they couldn't do anything about it because they're no longer here with us, but to buy and hold, that's all it took for them to be some of the best performing retail investors. So what I'm saying is, if you are invested into high quality compounders, they're in the red right now on a temporary basis, if they are truly high quality of a business, meaning eventually they're going to recover. And history shows us time and time again, good businesses running a tight ship with an economic moat with operations that are stellar, they tend to be okay. Not overnight, of course, but eventually. On the other hand, I'm so sorry I'm going to say this right now, but on the other hand, if you are invested into speculative companies that have negative free cash flow, inconsistent EPS earnings, and a decreasing or non-existent dividend, then I'm sorry to hear. I'm not saying you're wrong or stupid, but it could be a good time to switch teams to the one I belong to, the dividend investing team. Because even during a downturn, my dividend-paying stocks will pay rent to me for being a part of my portfolio. If growth stocks and dividend stocks are all in the red, you might as well collect passive income while you wait for the recovery. And the reason why I'm apologizing to you is these speculative companies, when it comes to them going through a tough time, that might be the last straw and the push that pushes them over the edge, and they usually go bankrupt. If they're struggling and they're drowning in debt and they're not profitable, dude, a stock market crash is usually the final nail in the coffin. I'm sorry, but there's always time to join the dividend investing team. We are always welcoming new members. However, it is important for me to say that not all dividend-paying stocks are created the same. This is only the case and example for fundamentally strong companies with good financials. That's why I try to only invest into companies that are built to survive during the hard times and to thrive during the good times. Because even a crappy company can still pay a crappy dividend. However, I would argue, and I'm going to show you here in a little bit, that's a minority of the companies out here in the stock market. For the most part, dividend-paying companies do tend to be quality. Not all of them, but the majority of them are good. Let me stop myself right here. It seems counterintuitive, but if a market crash isn't the right time to sell, then when do I plan on selling my stocks? Well, to answer that question, I only sell my stocks when I need capital for another investment, or if I believe a stock is overvalued and it's a good time to lock in those gains. Because it's nice to see my portfolio asset be in the green by 50%, but those are paper gains. Unless I sell and lock it in, then it's only 50% in theory. The next day, it could go down and I would only be in the green now by 25%. So it really depends. While I strongly believe in buying and holding long term in order to maximize compounding, because you can't allow a dividend compounder to do its magic if you only buy and hold for 2 or 3 months. It takes years for the compounding to work in your favor. So what I'm trying to say is, although I mostly agree with the phrase of buy and hold forever, I would say there are times when selling stocks make sense. If you're interested in my full reasoning, I made a video discussing when to sell stocks for a profit. It's a tricky subject to say the least, but in that video I go over all of the valid reasons and factors. So what is my game plan? I hate to be boring, but it's going to be the same as always. Despite what Mr. Market decides to do, I'm going to continue dollar cost averaging the fall, the sell-off, or whatever you want to call this right now. Because knowing me, if I just sit on the sidelines and I try to time the bottom, I'm going to regret it. And that's because the recovery in the stock market from the sell-off, it usually happens way too quickly, and before you know it, it's back to all-time highs and they've rebounded and they've recovered. And because I want to avoid that hypothetical situation, I'm going to do what I did last time. That was my exact game plan during the pandemic 2020 sell-off in February and March of 2020. And to be honest with you, it worked out great. Now, I'm not going to lie. The emotional side of me was like, dude, let's not buy in because I feel like it's going to drop further. However, the rational side of my brain was like, you know what? We cannot time the bottom. So let's just continue to dollar cost average this sell-off. So sometimes I would buy into a stock at negative 15% for that day. And then the following day, it went down by a further negative 8%. Did it feel good doing it at the time? Absolutely not. But fast forward 5 years later, I'm super happy that I did that. So that's my personal game plan. As for you, I would encourage you to stay the course as well. Invest into the red days. 2 to 5 years from now, you will thank yourself. By the way, that was not professional financial advice. I'm just looking out for you, amigo to amigo. And because I'm trying to look out for you, friend to friend, please do not buy into crap or speculative companies that are also going through this sell-off right now. Don't do that. But some companies that you might want to consider, like Microsoft, PepsiCo, or even McDonald's, then that's a whole different conversation. They are quite literally the definition of a high-quality dividend compounder with cheese. So buying them at a discount should feel like an opportunity instead of a risk, because with speculative companies, they're here today and you don't know if they're going to be here tomorrow. And believe me when I say, when it comes to dividend compounders with cheese, the type of companies that fit that definition, that's exactly the kind of businesses that you want to own when the market eventually turns around. And before you think high quality dividend compounders cut their dividends during tough times, that's not what the research and data shows us. So this is a study that was conducted by McKinsey, one of the biggest and most prestigious management consulting firms. And McKinsey found out when evaluating large cap dividend paying companies, 29% of them cut their dividends during the tough times, as you can see on your screen right now, which means 71% of these large cap dividend paying companies, they maintained or increased their dividend payouts in light of speed bumps. So this narrative that dividend paying companies are going to cut their dividends, yes, the crappy ones are going to do that. But the high quality compounders with Parmesan or mozzarella, dude, it's going to be smooth sailing. Of course, their margins might decrease a little bit and their free cash flow will also decline, but they should sail through the storm just fine, like they have in the past 20, 30, 40, 50 years of their company history. And in a normal year, when we talk about dividend cuts, take a look at it right here. The market rarely sees dividend cuts in any single year, except during economic crises. In other words, what McKinsey is saying is that in a normal year, not a catastrophic event, about 2% of the companies cut their dividends. That means as a dividend investor, my job is to invest into the other 98% who are not cutting their dividends, or the other 71% that do not cut their dividends during catastrophic economic downturn events. All that to say, as a dividend investor, wouldn't you say the odds are in my favor? And by the way, the odds get even better when I evaluate them and analyze them to make sure their financials, fundamentals, and economic moat and business story makes sense. Because out of that 71%, I would argue that I would probably only fancy and want to invest into probably 10% of that 71%. Not all of that 71% deserves to be in yours or my portfolio. that's why if you are considering retirement in the near future, this is why I believe that dividend investing is really important for you. Rather than relying on the traditional 4% withdrawal rate where you sell and you artificially create your own dividends, instead of doing all of that stupid work, even in a market downturn, you can rely on the high quality dividend stocks that continue to pay you that income that's predictable, reliable, and is consistent. Even if there's fear and there's red and the market is acting irrational, you can still predict that dividend payout, especially if you invest into the other 71% of the companies that do not cut their dividends during an economic downturn. If you want to dive a little deeper, then check out my playlist, The Case for Dividend Investing. It's basically a collection of videos that I have made breaking down why dividends win in the long run and why, even though I'm under the age of 40, I choose to do dividend growth investing for about 80% of my portfolio holdings, and the other 20%, yes, I do invest into growth, but growth is not the name of the game or the winner in the long run. And in the off chance that you are retired through dividend investing, can you please comment down below and let the people know that you are able to sleep at night without any worry or concern because your dividends come pouring in? Can you let them know that dividend investing actually works out in retirement? Please and thank you. And on that note, I just quickly want to say I am really excited. As a Seahawks fan, we have just brought in Sam Darnold, who was ranked number 6 NFL quarterback last season, to be our starting quarterback. And not only that, we brought him an offensive weapon in the form of Cooper Kupp. Are you kidding me? Dude, I'm so freaking excited for this upcoming NFL season. Now we have one of the best wide receivers. Well, I think he's top 10, and our defense is looking pretty darn scary. My only concern and call out is Cooper Kupp's durability. I don't know. If he can survive the entire season without getting injured, I think this is going to be a phenomenal trade and good investment. This is a dividend compounder with cheese, I would argue. So even though he has a pretty lengthy injury history, I'm going to choose to be positive and be optimistic of his future here with the Seattle Seahawks. Let's go. By the way, shout out to the Patreon family. Thank you for allowing me to do what I do. I love you guys so much. I'm serious when I say that. The income from YouTube is super inconsistent, but the fact that you guys choose to believe and support me through Patreon, it can make a grown man cry. I love you guys. Stay safe. Good luck in the stock market, and I'll talk to you guys next time. Peace.